day. We're seeing again another open to the downside in Asia this morning as WTI gets closer to $60 and Brent is well below 65. Let's kick off our conversation with Ed Bell, Senior Director of Market Economics at Emirates NBD. Ed, this trend, this declining trend seems to be locked in now over the last 7-8 trading sessions, except Friday interruption a little bit, but it's continued this week. What's your take on what's happening in the markets at the moment?
Yeah, I think there's a couple of things that have been driving the downward move that we've seen in oil prices. One is probably quite a bit of profit taking. So we're seeing long positions coming out of the market after we've had a more than a 30% gain in Brent and WTI futures up until about the last fortnight or so. And so people probably pulling some of those positions out with the $70 handle on Brent being a nice target. I think on top of that, you're also getting more anxieties about the demand outlook, at least in the very near term, where we're seeing that the virus caseloads in prominent European economies are really starting to deteriorate or grow quite rapidly again. So Germany announcing overnight that we're going to be seeing a more strict lockdown being imposed over the upcoming Easter holidays. France going into severe lockdowns for parts of the country. Again, not probably going to be as damaging to the economy as what we saw, say, in April to June last year, but still, nevertheless, not a very welcome signal to markets at this point.
Indeed. Let's bring in our other speakers. Sara Akbar, Chairperson and CEO of OiLSERV Kuwait, a non-executive director at Petrofac. Sara, we're always, it seems, a few days away from yet another OPEC meeting. With prices at these levels, what would your expectation be for their decision on April 1st?
Good morning, Shin. OPEC is being very secretive now, and the way they do this is they surprise the market. So really, I really don't know how they are going to surprise the market.
But well, what would be a surprise for you? What would be a surprise?
A surprise would be for them to for Saudi to put the 1 million back into the market, and for some of these OPEC countries to agree some kind of increase so that they at least stabilize the price at around 60, because I think at around 60, it's a win-win for them and for the consumer. So if there is a rational thinking within OPEC, then that's probably what they need to do.
What is the outlook, Sara, for the return of the joint oil field in the neutral zone between Saudi Arabia and Kuwait? There's been some talk over the last few days between the Kuwaiti and the Saudi minister. What is the likelihood that that could come back?
They are actually working it back into the system. It's been closed for like 3-4 years, and there has been a lot of maintenance work, a lot of rehabilitation work for the fields, but they are really well on track to come back to full production, both areas, the Kuwaiti side and the Saudi side.
And that would, at full production, what's the few 100,000 barrels?
300,000 barrels.
300,000 barrels. So a significant amount of oil that could be coming back onto the market. Let's welcome back to the table Narendra Taneja, India's leading energy expert. Narendra, like Europe, it seems that India is also having a bit of a setback with COVID resurgence, now in the top 3 in the world for infections at this time. What's the outlook for India?
Yeah, I mean, there's a bit of setback, especially in our key states such as Kerala and Maharashtra, which is like the locomotive of the economy, with Mumbai as its capital. So that's a little bit worrying, but it's still, I think, by and large, the country is doing fine and situation is very much under control. And that's the reason that when you look at the consumption figures of petrol, diesel, and turbine fuels and other commodities, that's more or less, there is no setback to that. And but we hope that within the next 2-3 weeks, situation would be more or less under control as the government pushes for vaccination campaign, and the results are there already for everybody to see. But as I said, I'm keeping my fingers crossed, and I hope that the states such as Maharashtra and Kerala and Karnataka and Punjab, they are able to control the situation as soon as possible, so that
are they in any type of lockdown, or is it just being managed without a lockdown?
Well, good question. You see, these are large states, especially Maharashtra. So there's a few pockets which are under lockdown, but by and large, the states are open. And but it has, of course, negative impact in terms of overall economic activities, as people are not able to move as freely. Goods are not able to move as freely as, for instance, let's say a couple of months, a couple of weeks back. So that situation is very much there, and they have received tough instructions from the federal government to control the situation on top priority, and which they are promised to do. So we hope that in next couple of weeks, situation should start getting back to more or less normal in these states too. But as I said, I'm still keeping my fingers crossed, looking at the quality of governance in some of these states, especially like Maharashtra and even parts of Punjab.
Ed, we've had some mixed signals now in these sort of emerging numbers as to whether we're going to see a return in travel in the coming months, given some countries have a pretty advanced vaccination program like the UK, the US, others not. We saw Etihad Airlines, the big Abu Dhabi airline, overnight sort of downgrading their expectations for recovery in travel. Where do you think that is looking at this time, that sort of extra part of the barrel, aviation fuel in general and travel?
Yeah, I think the kind of long haul flights that you'd expect to really be supporting demand, they're really going to be written off for the first half of the year. I think the advice we've seen from, for instance, the UK government over the weekend was they were basically telling UK residents, do not leave the country for your holidays. So basically staying at home. I do expect that, yeah, that more of that kind of travel activity gets pushed into the second half of the year. Certainly the UAE would probably be counting on it to help support the Expo 2020 that's going to be happening here in Dubai. I guess the difference this year compared with where we were last year is that, as you say, we are in the middle of vaccination campaign. So as those pick up pace, and as tourists or travelers feel more confident about going to a place like the UAE, for instance, which is very advanced in its vaccination programs, or the UK, which is also doing quite well, that may allow sort of those green shoots of demand recovery, of travel demand recovery, to be a little bit firmer and set us up nicely for a Q3, Q4 kind of recovery. But I really think at this point we're still very much not as bad nearly as we were in 2020, but by no means in a glowing state for travel consumption.
Sara, we're seeing increasingly Kuwait and its Gulf neighbors, of course, but Kuwait seems to be at the sort of sharp end of the knife of fiscal stress from the lower oil price cycle now, and the outlook for that from the point of view of strategy. Should the Gulf states, Kuwait being part of the OPEC Plus, be seeking to maximize price and revenue at this time rather than market share, and so keep their barrels locked in?
There are a couple of opinions about this. So every time we are in this situation where the oil price is down and we have fiscal problems with the cash flow for the state, we tend to put quickly some good plans how to diversify the economy and go back to the reasonable, rational way of running the state. Once the oil price goes up, like what happened now, they relax and we never do anything. We've been in this cycle for almost 60 years. So in my opinion,
at some point we get closer to a breaking point.
But yes, so as a citizen, of Kuwaiti citizen, I do want to see this reform badly, because without this reform, there is no sustainability for this country. And that's why I think this low oil price is actually more beneficial to us on the longer term than a high price, because in the high price scenario, we tend to forget what we really need to do as a country to be sustainable. We all know now, with everything that is happening in the world, climate change, the COP26 and the electrification of the world and all, We all know that oil as a fuel for industry, as fuel for transportation, is not going to be there. That there are better alternatives, not only for the world, but even for us. That's why we know that on the longer term, the oil as a base fuel will not have the same position. And unfortunately for Kuwait, we only have oil. We don't even have gas. We import.
Is that not argument to sell as much of it as you can right now rather than keep it in the ground?
Yes, of course. We think, there are multiple reforms even in the oil sector. We need to disentangle this and detach our economy from the oil somehow. And this is the only time, I think we have a break now with this oil price at this level, which we really need to utilize properly. But we need to keep reminding ourselves of this long-term future rather than the short-term spike in price. And I think, like I said, for all the oil exporting countries, a low oil scenario drives them more into reform, which is desperately needed. And you see what's happening in Kuwait now. Basically, the minister came out, he said, I don't have cash for salaries of the government employees. This is really horrible for a state. It's one of the wealthiest states of the world, but cash flow management and financial management is really horrible here.
Well, if you have by the Constitution, I believe you have to hire every college graduate into the public sector. It becomes an unbearable burden, right?
No, it's not in the Constitution. It's by what's been happening. It is not in the Constitution. The Constitution says you have to create job opportunities for all Kuwaitis. So it doesn't say that you have to hire them.
You don't have to hire them. Narendra, after the recent OPEC meeting, India was very vocal in their disappointment that that the OPEC Plus went for maximized price rather than listening to their customers and listening to India, who was asking for some consideration. And in the aftermath of that decision, it would appear India has instructed its importers to seek a diversified oil portfolio away from the Middle East. Can you tell us the outlook for that program?
Well, you see, as part of the energy security doctrine, we want to diversify. As you know, China has already done that. China is today importing crude from 40, 45 different countries. And we are trying to do exactly the same. For instance, until recently, Saudi Arabia was the main exporter of crude to India. Today is actually the US. And we want to diversify basically as part of the strategy, simply because, to depend only on any one geography or one region, that's not really a very smart energy security strategy. So it's just part of that. It does not mean that we want to reduce, by artificial means, our dependence on any one country of any one geography. But we see that Middle East in particular, is a very volatile region. And we see every day the news there, for instance, what's happening between Iran and other countries, and Yemen and Saudi Arabia and all that. So I think it only makes sense for us to diversify as to the extent possible, and at the same time build deeper bridges with all the Middle Eastern countries in terms of interdependence, in the sense we want them to come and invest in India. We want Kuwait, we want Iraq, we want Saudi Arabia to come and invest in India, both in upstream and downstream, so that we can build
the reporting on this story was, it seemed very much a reaction to the OPEC Plus decision. Was it, or was that over reported? And where do you see this sort of the tension, if you like, in as we move forward? Sara's saying, potentially a strategy of maximizing price as we enter into this age of demand, peak demand, whereas obviously India doesn't want to see that. How do you see this resolving?
No, 2 points, very quick points. You see, number one is that we have been working on this new doctrine to diversify already the last 5 years. It's nothing new. Okay. It's absolutely nothing new. It's just that more crude is available from the US for export than before. Number two is, of course, we don't like being a major importer. We don't like, for instance, the way OPEC in particular, they try to artificially manage the prices more to their advantage and not to the advantage of other stakeholders. We don't like that. And of course, there are a lot of merit in what Sara Akbar is saying. I mean, what I hope OPEC is listening to her. That's exactly the way we look at it. If you basically,
well, they did say in response, if you're concerned about the price, take some of that cheap oil out of storage that you bought last year.
Well, again, the point of energy security, we look at the geographical parking of India. We have tension with China. We have tension with Pakistan. There's a lot of military activity in the Indian Ocean. So we just can't do that just like that. I mean, it has to be a part of meditated strategy, and we don't feel very comfortable doing that. We are not building storage only for just to make money. We are building storage as part of a military strategy, just to make sure in case, for instance, oil supplies are cut to India in the event of war, what do? We saw in 1971 when two major suppliers, they stopped crude supply to India, and our refineries were deep in trouble. That happened only recently, 1971. If you look at so now the point is,
I'm glad you think that's recent. That
well,
makes
when you look at
that makes me feel better.
When you look at the world history, is like yesterday.
Yes, of course.
Yeah, and we learned the lesson. And but the point that Sara Akbar made, I think, is very, very important. It's important if, for instance, exporters, OPEC included, they can look at, for instance, somehow to stabilize prices in the region of, let's say, $55 to $60 per barrel. Today, we may want oil at 40, but maybe 6 months down the line, India will be very comfortable with 60 also, in the sense. But if that means more projects for Indian exporters in the Middle East, more demand for our workforce in the Middle, then it's perfectly okay. You see, but the point is that artificially what OPEC tries to do is very medieval, very old-fashioned. OPEC should become modern thinking entity, if at all. Otherwise, in this age, in 2021, carters like OPEC should have absolutely no place.
Ed, meanwhile, back at the ranch of Joe Biden, the checks are barely in the post, and we're already getting reports from the White House of yet another $3 trillion of potential stimulus into infrastructure and other programs. What's your reading on that? Where do you think that takes inflation and other issues that challenge the market going forward?
Yeah, this is the next big push from the Biden administration for a wholesale, let's say, call it infrastructure plan, although it won't entirely encapsulate just sort of bricks and concrete and steel kind of projects, but a general kind of upgrading of the U.S. economy to catch up with, as Joe Biden has put it out, a long run, decades-long competition that they're going to be doing with China. Now, the overall price tag that's being talked about right now of $3 trillion obviously sounds enormous, but let's bear in mind a couple of things. One is that that's going to be probably spent out over a very long period. So maybe a sort of a 10-year kind of time horizon in which those projects would be spent on. And also it's most likely, given what we're seeing in terms of the sort of components of it, that it's going to be compartmentalized. So some of it might be your classic infrastructure programs, upgrades to rail networks, to road networks, building things like new airports that probably don't have as much partisan bias towards them. So seemingly likely that you could get those passed through towards the end of the year. Other elements, though, such as a big shift towards a greening of the U.S. economy, not quite as far as perhaps the Green New Deal that some people in some of the sort of more progressive elements of the Democrat Party wanted, maybe not as extreme as that, but still incorporating a huge amount of kind of renewable investment, of green skills, sort of upgrading job skills in the sector could also be included. And that's one where already we're seeing comments from Senate Republicans basically saying that's a complete non-starter. We're not interested in anything in that kind of ballpark just yet. So it's hard to say exactly how much of this $3 trillion number will actually materialize into the market or into the U.S. economy, but certainly a good portion of it is likely to come in and be a very productive form of investment that I think the U.S. economy is desperately being needed. Now, we've seen constant debate. I think the main debate, at least in financial markets, is will it, won't it? Will we have this emergence of inflation as a real risk? And some very aggressive commentary out from Larry Summers, who was involved in the Obama administration, saying that basically he's seeing the worst economic policymaking in 40 years undergoing in the United States right now. We are still not of the view that inflation is going to materialize in a detrimental way at some point this year. There's no doubt that inflation is going to be higher in the second quarter. CPI levels in the US were around 0.5% in Q2.
How does that play out for countries like in the Gulf and elsewhere that are pegged to the US dollar? Where does that stress or not come our way?
Well, I think for them, it's really counting on the Fed sticking to its guns in the statement that they had last week, saying that they will respond to actual changes in the data. They want to see actual inflation. They want to see the employment market in the US improving in real terms, not just projections, not just forecasts. And so I think we got a little bit of a break for the GCC economies with a very dovish Fed last week, pledging to keep rates on hold, probably at least until 2024, based on their own projections. And so that helps to keep borrowing costs low for the GCC economies.
Sara, the IEA put out a report last week, sort of a midterm 5-year outlook, in which there was a fairly positive outlook for the call on OPEC crude, where it stated that the Gulf states in particular would have to significantly increase their production capacity in order to meet supply requirements 24 and 2025 because of the collapse in capital investment by the international industry. What's your read on that report? Do you concur with it? How well placed are the Gulf states to meet those expectations?
Yes. So before this pandemic, the annual decline in production, the natural decline of the oil fields around the world was around 5 million barrels. So, and there was about
per year,
and there was a growth potential of 3 to 5 million, because of economic activity and so on. So, our investments in the oil and gas were catered for two things: to capture this decline and to add for the growth. Now, the growth, of course, because of this pandemic, because of what's happening with the world, we don't think we can rely on. But at least we know that we have to cover for the decline. And the decline normally you cover for by exploration, which didn't happen much, over the last 3-4 years. Actually, it's not something recent. So there wasn't a big exploration activity by oil companies because of the capital constraints, the nature of the exploration, and so on. What compensated for this was the shale oil from the US. But now the shale in the US is in trouble as well. And maybe, I saw this part of the report today that there is some capital that going into the market, and it's easier now to get capital for investment. It is so linked to capital and the sentiment in the market that you can't rely on that. So the reality is there will be shortage if we don't cover for the natural decline of these oil fields all over the world. And the only countries that have potential to capture that are countries from the Middle East. So Iraq, I think, can be the biggest contributor to this, increase, to close the gap.
Given its reserves.
It is the only country where you still have reserves that really need to be developed. It's discovered, it's not developed. Right. And then, of course, Iran coming back to the market, if they do come back to the market. So again, you have potential in Iran. And I'm sure you saw the UAE, they have firm plans to go to 5 million barrels.
Yes.
Kuwait plans to go to something like 3.2 or 3.4 million barrels by 2025. So yes, there is capacity within the countries in the GCC and in the Middle East to close the gap. However, it is again investment related.
Yeah, we did see yesterday Aramco report its annual earnings and actually indicate that they themselves would also be cutting back on their capital expenditure given the collapse in revenue that they've suffered. Let's go to the survey question today, because a lot of the immediate market outlook is where is the rest of this year going in terms of recovery? And from one week to the next, it all looks very positive, and the next week, not so much. And this week, clearly, oil prices are being impacted by the outlook for Europe is looking uncertain as to when they can recover, get the vaccine rollout, and get back to normal. So the question today is, when do you expect Europe to return to something that looks like post-COVID normal? Is it in the third quarter? There's been a lot of talk most of the year that the second half of the year would be the big recovery. But indeed, will that come to Europe in Q3, Q4, or will we have to wait till 2022? So welcome people's views on that. Submit your vote, and we will go to Narendra next. Narendra, OPEC meeting in a week's time. What do you think they should do? What would you like them to do?
Well, simply just to kind of, let more crude oil flow in the market. And because artificially what they are trying to do is they will realize very soon is counterproductive. You see, if oil is available at the price that, for instance, is good for the global economy in general, and for economy of countries such as India and a few others in particular, actually is only going to help them, because it's important times like these that they realize that we live in the world of interdependence, the time when they could dictate terms, when they could just look at the world only from their viewpoint, completely ignoring importing countries such as India or China for that matter. I think that time is over.
And maybe also, is there a risk, Narendra, that the OPEC, the Gulf states, could be giving up market share to US exports, for example? We're seeing 3 million plus oil barrels coming out of the US now, and some of it making its way to Asian markets.
Well, what's wrong with that? We've just seen reports like, I think on your channel only, that even China is importing more from North Sea. So yes. I think we live in a competitive world. I mean, they got to realize the GCC countries have lived in this kind of bubble for too long. They got to realize that bubble is going to go away very soon, and they will have to compete, and they will have to, instead of India knocking at OPEC and Saudi Arabia or Kuwait and Iraq, is wait for another 7 months. They will be the one who will be actually knocking in New Delhi and Shanghai and Peking and Jakarta and all these places. So, I mean, the world is changing. Sooner they realize better it is the time when they should actually, build bridges with big importing countries, also large economies like India, because they will need economies like India to sustain their growth, to actually go for the kind of transition that they have no alternative but to go through, to rebuild their economy based on not only oil but other economic activities too, where India can be a great contributor. So I think it's the time that they handhold, and it's the time when they should actually think in terms of interdependence. Invest. So
you would be advocating that the time has arrived. India's view would be the time has arrived to move beyond controlling supply to elevate price, but just pump what you can and let the chips fall where they may.
Absolutely. You have already seen, I mean, we are going to get oil from wherever it is available. If it's available from the US at, it works for us very well. US is a very important close friend of India. And even if it is from wherever, we've
seen China import a lot of sanction busting oil from Iran. Would India be looking to do the same, do you think?
Well, we are looking for the day when the Biden administration is okay with that. And we don't want to kind of import oil from Iran at the cost of our strategic relationship with the United States. That's very clear. But at the same time, we are trying to convince the US as best as we can that we can have good, close strategic relationship with you. But at the same time, Iran is our civilizational neighbor. We have very close ties with Iran, and we want to import more oil from Iran. We want to build gas pipeline from Iran to India, and we want to deepen our energy ties with Iran. Iran is a great country, and they've got huge reserves, and we know how to deal with them. And they're very, very close friends, civilization friends for centuries. So I think
maybe it's time for India. Well, it's way beyond time. I would argue for India to have a seat at the Security Council, permanent member. That's another story and another big subject, which we won't get into right now, but it might be relevant at times like this. Let's go to the survey result and give Ed the last word today. So 2022, not a lot of confidence in this room for recovery in Europe this year. And somebody actually said in the chat room, where's the option for 2024? So Ed, should we see a lot more stimulus, or are we entering the period in which we're towards the end of stimulus and now it's navigating our way out of that reality?
I don't think it's necessarily wholesale anymore. Certainly the US has gone a big way since the start of the year in terms of introducing stimulatory measures. So I think the push there is probably going to be more muted until we get this $3 trillion program up
It's
and
no
running.
longer billion, baby. It's trillion now. We all have to get that word in our mouth. Trillion. It's a little bit more difficult than billion.
Europe needs more help. I mean, if we think about where we were in the summer last year, the Eurozone was looking like it was going to be the one that was going to come rip-roaring out of the COVID-19 pandemic. They had this 750 billion euro package agreed, seemingly a better handle on the health response to the crisis. They've really gone out of their way, I think, to sort of snatch defeat from the jaws of victory with a lot of dysfunction within the political machinations of the Eurozone, and certainly the kind of public airing of, in some ways, public airing of dirty laundry around the AstraZeneca vaccine, I think has really pushed back the hopes and aspirations that the Eurozone economy was going to get its act together this year. So 2024 probably would have been my option too, if it had been an option there, given that they've really seemed to have shot themselves in the foot so much and do need to see a lot more stimulus coming in. But judging by the way it's set up, they're going to put everything on the plate of the ECB, and they're really kind of tapping out in terms of what's available to them.
We had seen a lot of stocks in the equity markets, airlines and leisure companies, and also oil itself was obviously rising on the back of expectations that the second half would bring a lot of relief to the travel and leisure industry. That looks now to be under a question mark, and with it, hard to see oil prices recovering back to 70 when we've got 8 million barrels of idle supply and a question mark over the return of the travel industry. But those are things to think about during the rest of this trading week. I'd like to thank our guest this morning, Narendra Taneja from India. Thank you for your thoughts and insights. Sara Akbar, as always, from Kuwait. Really appreciate your participation. And Ed Bell, Emirates NBD here in Dubai. Thank you so much for your insights. Everybody have a great day, and we'll catch you over the rest of the week. All the best. Thank you.